So today we're going to look at transactions for a merchandising company, and you read about that in Chapter 6 of the textbook. And what we have to remember with merchandising companies is that we have an additional expense, cost of goods sold. We also have sales revenue instead of service revenue. So we have to make sure that we record all of that properly. Now, in addition to that, we have terms of sale. If you recall, for example, 115 means we get 1% off if we pay within 15 days. And then the net EOM means end of month. That could also be net 30, due within 30 days. Could be a variety of different terms. And then we have the FOB, the free on board. That determines the cost of the freight. In other words, who pays the cost of the freight. If we have FOB shipping point, free on board shipping point, it means that the seller is not paying the freight, the buyer is, which is the most common situation. FOB destination means that the seller is paying the freight. FOB, or free on board, is an old railroad term, and there is some legal issues with like ownership of the freight and so on that surrounds this, but we're more concerned with the accounting piece of it. Now, another thing we're going to do, and again, this isn't going to be a perfect measurement here, but because we haven't gotten into how to calculate cost of goods sold, they're going to give us that number here. But we're going to figure out our gross profit, which is sales minus cost of goods sold, and our gross profit percentage, an important number for a merchandiser, because before they deduct any expenses, they want to know what their gross profit is. In other words, what's their profit just from selling their merchandise? So the first transaction we have here is September 3rd, where we purchased merchandise inventory on account from Sherry Company. So, again, if we buy merchandise for cash, there's not going to be any terms because we're paying right up front. So we're just going to use the word inventory to indicate merchandise inventory. So we would debit inventory for $4,000, and we know it's on account, so we're going to credit accounts payable for $4,000. Now, paid the freight bill of $75 from the September 3rd purchase. So we know that we, as the buyer, have to pay the freight bill because it's FOB shipping point. So that means that the buyer needs to pay the freight. Now, under the perpetual method of inventory, there is no freight in or freight out or freight expense kind of account. It would be that we would have that under the periodic method. But under the perpetual method, we have to consider that freight is part of the cost of inventory. It's part of the cost of getting the inventory to our store or to our places that we're going to sell it. So we also have to remember that inventory has discount in some cases, but freight is not going to be part of that discount. So what we have to do is debit inventory here, but we also, I would suggest, put in parentheses freight, so we know not to include it as part of our discount calculation. Okay, and we're paying cash. So once we get to the next transaction, we see that on September 4th also, we purchased merchandise inventory for cash. So you'll notice that there's no terms. Okay, and we're not given any information on the freight for this particular transaction. So we have to assume that it's FOB destination because they're not telling us anything about it. So So again, there are no terms because we're paying cash right up front. Okay, so we're going to debit inventory for $1,900. We're going to credit cash for $1,900. Okay, so now we're on the 6th, and we returned $1,100 of the merchandise from the September 3rd purchase. So we don't know why, or for whatever reason. Maybe it was defective. We don't really know, okay, based on the information we're given. But if we return it, we're not going to pay for it, right? So we have to debit accounts payable for $1,100, and we're going to credit inventory, right? Remember, we're using inventory as a shortcut for merchandise inventory. So again, if we return it, we're not going to pay for it. So that would be our entry there. Now, when it comes to sales, depends on whether the company is publicly held or not. In a publicly held corporation, any sales discount has to be taken up front. Your textbook does not reflect this, and because I think it's focusing on a sole proprietorship, which you would not have to do that. So we're going to go with the textbook model, but just be aware, in a large publicly held company, they are required by the FASB to take any sales discount, okay, at the time of sale. And the reason for that is because they were concerned about companies trying to push off discounts into a new accounting period to make their net income look better than it really was. So we're going to go with what the book has, but just keep that in mind. Okay. So sold merchandise inventory to Houston Company. So if there are terms, we know it's on account, because if it was for cash, they would have just given us the money and we'd be done with it. Okay, so we know it's going to be accounts receivable. And I would suggest that in order to avoid confusion, we put the company name, okay, with either a backslash or a dash or something, so we don't get confused. And this is going to be sales revenue, right? It's not service revenue, it's sales revenue. Sales revenue means that we are transferring a good for consideration, essentially cash or a promise to pay cash, which is what an accounts receivable is. So if we go back here, and we're just going to make this Sherry up here, just so we know, if we have to go back to these transactions. Okay, so those are the first few transactions. What we'll do in the next video is we will continue with each of these transactions. Thank you for your attention.